Well, consumer prices in April remained sticky despite some signs of cooling, inflation continuing to run above the Fed's target. It's a target that will likely remain elusive as the tariff impact to consumers remains a risk. For more on where the road ahead for inflation is going, let's get to RBC Capital Markets economist Carrie Freestone joining us in the studio. Carrie, thanks for being here.
Thanks for having me.
So the inflation reading, first of all, backward looking, doesn't include a lot of the tariffs, did come in better than estimated. But let's look forward when it comes to inflation, because you and your team don't think that this is the low. You think that we're going to continue to see a trend higher.
Absolutely. I mean, we really haven't seen the full impact of tariffs come through yet. And it was actually surprising this morning because even if you looked at the auto sector, we actually saw a pullback in motor vehicle parts and equipment. And that's something that surprised me. And it's really telling us that, it's going to be a while for firms to change their behavior and for us to start to see an impact on core goods prices. Now, one thing that's positive is obviously the administration's walk back yesterday on tariffs on U.S. imports from China is a positive development. But the average effective tariff rate here in the U.S. is still 13%, which is 5 times higher than a year ago. So while previously we thought core inflation by the end of the year might be 4%, we're now thinking closer to 3%, but that's still quite a ways away from the Fed's target, right? So, the current backdrop makes it exceptionally challenging for us to get to where we want to be.
Karen, I'm just interested with oil at 63, how does that play into your inflation outlook?
Yeah, so we're definitely in a situation where we're going to see downward pressure from energy prices and upward pressure from core goods. So we're in a situation where we're going to see that switch a little bit, and the pressure is really going to be coming through from core in the year ahead. Even today, 2.8% core, so that's where we're seeing a lot of the pressure, and that's something that we can expect to continue to see.
So what does all of this mean for the Federal Reserve, right? Because on the one hand, the tariffs coming off the worst case scenario seem to be a positive development for the Fed's efforts to balance its dual mandate. But then if we are still going to see that trickle through, it's still going to be potentially challenging for them, right?
They're still in a challenging position. At the last meeting, Chair Powell emphasized that, there's time to exercise patience. And I think that's even more true today after yesterday's announcements. But we're still in a situation where, when we see the upward pressure on core goods prices, that's going to result in a real erosion in consumer purchasing power, right? So we could still see, a hit to the labor market, specifically in those trade-exposed sectors. And while, Chair Powell's been non-committal about which side of the mandate he's going to think bears more weight, in our view at RBC, we lean towards the fact that we think they're going to be concerned about higher unemployment. So right now in our forecast, we have 3 cuts baked in the back half of the year. Now, again, it's a fast-evolving situation, so things could definitely change. But we do think that side of the mandate is going to bear more weight.
Well, I'm just curious more broadly, Carrie, what's the RBC kind of house view of how the U.S. economy evolves over 2025? With the U.S.-China trade truce, I know you're reading through all these published reports. There are plenty of economists who are saying, well, okay, our odds of recession risk are receding. Is that your view?
Absolutely. I think the discussion in the near term of recession risks has maybe pivoted for a little bit, but I do want to highlight, we still have 30% tariffs on imports from China, right? So that's still, way worse off than we were a few months ago. And so that is going to hit the U.S. consumer. And while we think that, there is some upside risk to our growth forecast for Q2 and Q3, we're still in a situation where growth is going to be softer this year than it was in the past few years, especially when we were in a situation where the consumer had exceptional momentum. We think that's going to cool off. So, we're not expecting to see a recession this year, but we are definitely expecting to see cooler growth.
I have a 2Q GDP question for you. What we saw in the first quarter was a surge in imports as people tried to get ahead of the tariffs. Then the tariffs got put in place. Now we have this sort of come down of the tariffs to some extent. And there has been some reporting out there that, importers in the U.S. were waiting for the tariffs to come down to load ships up and bring goods into the U.S. So does that mean we also risk in the second quarter seeing another rise in inventory that could then push GDP down? Or you don't think I see from your face you're skeptical. You don't think it's going to be that big of an effect?
I think most of the effect will be baked in Q1. So Q1, ultimately, we think, it was negative, and we think that Q2 is not going to be negative. We're not expecting to see, such a significant buildup in inventories. But again, we don't see the full impact of tariffs fully baking out in Q2. It likely will be into the summer months before we see that impact on inflation and then growth. And the reason for that is it takes businesses time to make decisions to pass off those higher prices. We saw inventories surge in Q1. We're likely going to see that into Q2. And so we're probably not going to see the higher prices materialize until the summer.
Gotcha.
Carrie, great to have you here on set. Thanks so much for coming in.
Thanks again.